With borrowing costs retreating from their highs and mortgage rates falling within the past year, experts are saying there's a new level of optimism in the commercial real estate space. I want to send things over to NYC content creator Ashley Mastronardi, who's standing by with more. Ashley, over to you.
Good morning again, Kristen. In fact, one expert says that commercial real estate is at a, quote, turning point. Joining me now is Hessam Nadji. He's the CEO of Marcus & Millichap, an investment firm focused on commercial real estate. Hessam, welcome.
Good morning. Great to be with you.
So before we dive into the state of commercial real estate, what type of work and services are your firm providing?
Marcus & Millichap is the largest firm in North America specializing in investment real estate brokerage, financing, research, and advisory services. We've specialized for 55 years in making a market for commercial real estate assets for private investors, institutions, lenders, and foreign investors. And we provide the largest sales force of investment specialists in the industry of around 1,700 professionals that specialize in the space, covering every property type from multifamily apartment investments, offices, shopping centers, to self-storage, medical office, seniors housing, mobile home parks. And it's been a wonderful sort of a 50-year plus cycle of seeing commercial real estate become a mainstay, not just among private investors who dominate this industry, but institutional capital coming into the space as well.
And you said that the commercial real estate industry is at a turning point. Can you elaborate on that?
Well, the industry is very cyclical and interest rate dependent, especially for private investors who rely on leverage and the financing component of the business to execute their transactions. On average, 60 to 70% of the value of each transaction is financed by banks, insurance companies, pension fund advisors, and other forms of either equity investors or lenders. And therefore, the liquidity in the marketplace is highly dependent on interest rates and loan to value ratios. In other words, what percent of the value lenders are willing to finance. When the risk tolerance is at a low point during recessions and other shocks to the economy, the loan to value ratios drop and it's harder to get financing. Therefore, the transaction market slows way down. We saw that in 2023 after the Fed basically took a sledgehammer to interest rates to battle inflation, and the market had to recalibrate. It's taken almost 2 years now, over 2 years, for the prices to adjust and valuations to have to adjust to the higher interest rates and the uncertainty that's been in the marketplace. We are coming out of that fog. And that's why 2026 is a turning point. Given interest rates are coming in, values have adjusted by somewhere around 20% on average. Office buildings have seen a much bigger value hit than, let's say, multifamily assets or single tenant net lease assets, such as your fast food restaurants, auto parts, real estate investments that are there for a long-term lease. So it's a very wide variation of yields and pricing, but overall the industry is well positioned to go into 2026 with a fresh start.
And you mentioned office space. What trends have you observed in the commercial real estate sector, especially in that area, since the pandemic?
Well, we saw a demand shock unlike anything we've ever seen. Office buildings had not been overbuilt. They were performing just fine prior to the pandemic. And then, of course, there was a once in a century life type of event that shocked demand in a way that nobody had predicted. And the exodus out of urban markets in particular really hurt those types of markets, especially New York, San Francisco, Chicago, Seattle, pretty much across the country. And very, very gradually, we've seen that demand come back, especially in the last 12 months or so with the mandate to return to office, now bringing daily traffic up to about 85% of where it was pre-pandemic. And just as a point of comparison, a year ago, it was around 60%. 2 years ago, it was below 50%. So we're seeing a big resurgence of daily traffic into office space. Nonetheless, the pandemic has caused a permanent shift in the way that we all work. So the hybrid formula, even if it's 4 days in the office, 1 day virtual, or 3-2, or whatever it is, will reduce office space demand. The good news is that the supply side, new construction, has been very limited, and the market is adjusting. So the office investment prospect is the diamond in the rough. We actually declared that over a year ago, and there are some great valuations to take advantage of.
All right, thank you, Hessam Nadji, CEO of Marcus and Millichap, for joining us.
Thanks for having me on.